What's up, guys? I'm Nobody Special, and I have the channel's gold guy is with us today. Bob, congratulations. You are the unofficial gold guy of Nobody Special Finance. With me today is Bob Coleman from Idaho Armored Vaults, and he's going to help us make heads or tails out of the price action in precious metals from this week. Bob, welcome back on the channel. Thank you for joining us. And how you doing? I mean, it's been a crazy week for you, hasn't it? I take it.
Yeah, it's been nonstop volatility and phones ringing off the hook. So sometimes it's fun, sometimes it gets a little stressful. But yeah, being in the markets since 1992, this isn't my first rodeo.
All right, so you've seen a thing or two. You're like that guy from the State Farm commercial, and we're going to ask you a thing or two today about this. The first thing I got to do is I'm going to share my screen here. And I have to bring this chart up. This is the gold chart. We're looking at 1 hour candles. And I threw a little note up there on the screen when the tariffs were announced, right? A little around 4:30 p.m. Wednesday Eastern time. Initially, gold reacts to the upside, yay, tariffs. Then it starts selling off. Shortly after market open, it recovers. It almost goes positive for the day. And then the sell-off resumes. And then, of course, today, just a bloodbath in gold. So help us understand, because I've seen the dollar go lower. I've seen interest rates go lower, two things that should be rocket fuel for gold. And yet we've got gold selling off this week. So what happened?
So some of the news, I guess, was in the metals. You could say, I mean, it was built for some type of tariff issue. What kind of, I think, affected the metals per se is this sort of waiver that the bullion received in the reciprocal tariff type arrangements. And so if you want to go back to that chart, I'll kind of walk you through when that tariff was announced, that spike up that you kind of saw, and it kind of took effect that afternoon into the evening. That the move there was due to tariffs being enacted on Switzerland, and there was at the time there was a lot of uncertainty if bullion products or metals, not necessarily refined bullion, but just metals in general, would be actually tariffed. And all of a sudden, that started to shoot the prices of metals, of gold up. Obviously, Swiss is a big exporter of precious metals, and obviously of refining capacity and so forth. So when some clarity kind of came through the next morning, obviously that's when the gold market started to sell off. And what ended up happening was, the tariff announcement was actually very impactful on the general market, because it was a lot more, I guess, a little bit more punitive than what people had previously thought. So the general market started going down. That created that liquidity event. Gold held somewhat steady. But, obviously today, this sort of big move from yesterday and today, it's just getting caught up with this, massive liquidation that's happening across all the general markets. And you have to remember, these markets are very integrated together. Hedge funds, money managers, traders, they use different instruments to hedge other instruments or to provide diversity and that type of thing. The problem is, when everybody's doing the same thing, these instruments don't really add diversity and hedging. They get caught up in a liquidation type mode. They just get caught up with the margin calls, and then people are forced to sell. Gold's up on the year. It's very simple to say, listen, I'm going to go ahead and dump my gold, take a profit. At least that looks good on my P&L, and I'll use that profit to offset some of the losses or reduce my margin costs on other types of assets.
So you mentioned margin calls a couple of times there, and certainly stocks have seen no shortage of them. I just saw a headline today. We're recording Friday evening. Today was the busiest day for hedge fund margin calls since March of 2020. Did we have maybe some levered longs over the last few days in gold? Obviously, gold has had one heck of a run this year. Maybe a little bit of froth built up in the gold market. People went out on leverage, betting that would continue. And then when the tariffs exempted bullion and that price action started to reverse, did we just get liquidation of those levered longs, or was it just across the board? Was it everybody started selling?
The metals weren't immune to it. I mean, when you have the type of liquidation and the drop in the markets, just like March of 2020, silver had its biggest one-day drop since March of 2020. So,
Mm.
this gold silver ratio blowing out, for example, that's a sign of liquidity and stress. Relative to another market, and of course, silver being a much smaller market, it can have exaggerated moves. And so you saw very similar actions like we saw in March of 2020. I think in a 3-day period, or within a week, that ratio went from 100 to 125. It just zoomed. So this is just another indication of stress within the system. And a lack of liquidity. There was a lot of talk that I heard this week. Dealers, for example, the last week or so, being heavy in inventory, light on cash. So you may have had dealers selling product. Like obviously today was a big day for buying. You saw some of the wholesalers ticking up premiums because of the price action. But going into this, though, there was a lot of people selling, a lot of retail selling as the prices were 3,100, 3,150 on gold. Just people saying, listen, it's time me to take a profit, or I've been in this a long time. I feel like I've made some money in it, and I need income. I need my life has completely changed from what it was 15 years ago. So you had that sort of dealers kind of heavy in terms of inventory, these are things that you just try to watch for. It gives you a sense for the overall conditions of the precious metals industry. I know I've talked a lot about this in the past with the EFP, that exchange for physical premium. It's basically a spread trade between the physical market, typically in London, and the futures market in New York. And so, what kind of shot the markets up over the last 3 months was a financial type of event where there was pressure on the short side of that spread or that leg. So the futures price was climbing at an accelerated rate versus the physical market. Well, with some clarity in the futures market, or some clarity with tariffs and so forth, what's happened today was you had an accelerated reversal of that EFP, where it shrank. It actually went from, like, for example, silver was at an 80-cent premium the other day. It dropped to an 8-cent discount relative. So futures now are cheaper than the actual spot price of metal. So that's what they call backwardation, and that type of move accelerating to the downside also led to margin calls. So, for example, let's say you're a long speculator, you're long futures market, you're long silver futures or gold futures, and now the futures market is accelerating the selling to the downside faster than, say, for example, the guy who just owns physical metal. He didn't see as much of a bloodbath, but that impact of that accelerated EFP, or that short leg now going to the downside, just exacerbated the margin calls that people that were just sitting there long.
So that's a pretty good segue there, that EFP collapse, because the last time you came on this channel was a couple of months ago. We were watching the EFPs, as you pointed out. That premium was blowing out as the London metal drain. The metal was leaving London, coming to New York out of fear of tariffs, and it was causing those exchange for physical premiums to move higher versus spot price. And now we're seeing that slam shut because the tariffs have been exempted from, or the bullion has been exempted from the tariffs. So this London to New York metal drain, is it over? I mean, is that done now?
Yeah, I've been talking about this for about a week, or last couple of weeks, where I was about in March, or I'm sorry, February of 2021. We had that silver squeeze type esque moment, and I think it was January 31st or February 1st. And then the metals actually peaked. They did sort of a double top. They had a peak in registered category in January, and I think then it peaked in February. And then I was calling for it to basically, that was it. We were probably going to go down from there, and I was about a week off. So I missed it by just a week. I think we're in that same boat now, where now that we're in backwardation, and I was saying this the last couple of weeks, that, well, actually really the last 3 or 4 weeks, that now the risk is, and what people are not expecting is not a EFP to rise and the contango to widen. Now we go toward an easing of the EFP and toward backwardation, which is what nobody was talking about. And that's exactly what we're doing right now. So what you're seeing, what that basically means in golden retriever terms is, the next stage of this market is being laid out in front of us. It's going to determine the price action for the metals going forward. If investment demand dies off, the metals will, it'll consolidate. It'll kind of chew through this sort of time period where it has to digest that big move. You may get more volatility, but if the investment demand starts to pick up, and for example, people say, listen, the tariffs may not be done. Right now there's exemptions, but the trade war may not be done, especially if the economies around the world start to falter because their asset prices and stock markets and so forth are falling. We may see a tightening of the belt, more populism, more nationalism, and more protection of each other's own economies. The story may not be over. And I think if you really want to get into the nuts and bolts of this this move, and I think what the administration's attempt is, I think if it's basically trying to get interest rates lower, forcing the Fed to cut rates. So ultimately it does two things. It reduces the federal deficit because it'll lower the interest costs, because you got to remember, there's a lot of front loading of US T-bills that Yellen did during the Biden administration. And so I think what the Bissent is trying to do, and he's a smart guy. He's saying, listen, you got $4.5 trillion of debt that's going to be rolling over this year. Let's see if we can get interest rates down. That'll have a direct effect on interest costs. That'll have a direct effect on the federal deficits, and so therefore we can maybe chew through these deficits without cutting other programs and that type of thing, or maybe we can add tax cuts to that because we were able to save money on the interest costs. But the other side to the equation is they need the Fed to either print money or through QE, and also to lower rates for that whole thing to develop. Because what you're going to end up doing is you're having to burn down the house, meaning you have to burn the stock market down and kill asset prices in order to get the Fed motivated enough to start cutting rates and start removing QT and going to QE.
And Powell had the opportunity to blink today, and he did not bite. Powell came out today. He gave a speech at this smaller event that WAPO organized, and he just flat out said, no, this is not the time for Fed action. We're going to wait and see. So more pain is in store is what that sounds like. The Fed will not be riding to the rescue yet.
Yes, I'll tell you, it is a very dangerous game when you throw a financial market that has been based on leverage really since, you could go back 30, 40 years, but really since the great financial crisis in 2008, leverage has just compounded on leverage. Structured products have compounded upon structured products. Volatility products have entered the fray. Zero DTE options. I mean, this whole market has gone into this immediacy of risk taking and risk management, and you get these events like vol blowing out or other types of things that these are the downside of fall compression and some of the things that we see in the financial markets in general. People getting too comfortable and constantly selling vol, picking up the nickels in front of the steamroller. Well, when that steamroller comes, you just get run over, and that's what we kind of saw the last couple of days.
Yeah, you mentioned the nickels or pennies in front of the steamroller. I mean, that's your basis trade, right? The people who are buying cash bonds and then selling cash bond or selling bond futures against them. Their net positioning is very small. They're harvesting that little bit, fractions of a penny on these trades, but they're doing it billions and billions of times. So it turns into real money. And that's fine as long as there's no volatility in the bond market. And then as soon as the volatility shows up in the bond market, it just blows out. Those trades blow up. And that's what forced Powell to move in March of 2020 was when that basis trade in the U.S. Treasury market blew out. It wasn't stocks. It was the volatility in the bond market that ultimately made him act, and we're not there yet. So now, another thing you mentioned here about you mentioned two things that are going to queue up my next question. You mentioned the gold to silver ratio. I'm loving that. I want to show you this chart in a second, but also Besant and how, he wants lower rates. He also wants a lower dollar because he wants U.S. trade to be more competitive, or U.S. manufacturing and exports to be more competitive. And, a lot of people don't know this about Besant, or at least, since he kind of hit the scene politically. He's a protege of George Soros. He is a big time currency manipulator. He's one of the chief architects of George Soros's takedown of the British pound decades ago, and then a smaller bet against the yen. So, I mean, if this guy wants a currency lower, he knows how to get it. And right now he's getting his lower rates. So we're talking lower rates. We're talking cheaper dollar. We're talking Fed rate cuts, all things that happened in 2020 in March, all things that are traditionally very good for precious metal prices. Now, I've got this chart that I flashed. I teased this a few minutes ago, and I put this out on my X feed today. This is shown in blue here is the gold to silver ratio, basically the spot price of gold divided by the spot price of silver. And we're seeing this go vertical now. It's over 100. An ounce of gold is worth 102 ounces of silver now. And then in red is shown the price of silver. The price of silver has been in free fall, and it's falling a lot faster than gold is falling right now. And that's why the gold to silver ratio is rising. The last time we had these conditions, a rapid decline in silver prices with a rapid increase in the gold to silver ratio, was March of 2020. And as you can see, what the red line did shortly after that, as soon as that basis trade blew up and the Fed started their QE, silver just went on a rip your face off rally from $12 to $28 in a span of a couple of weeks. Now, obviously, it's not 2020. There's a lot of things that are different now. Do you see, what are the similarities in this setup? And is there anything that jumps out at you as different that might say, okay, this time it's not going to go that way?
Yeah, I always hate to say it's different this time. I've been doing this so long that the moment you say that, just discount anybody who says
right?
that. Yeah, I think what you're seeing is kind of an opposite of what happened in going into COVID. Here the metal prices were at highs, built in for some news with tariffs, and you got an unwind of the tariffs, and you got also liquidation and some of the sell on the news or whatever you want to call it, but you got some liquidation that turned into, like I mentioned, the EFP disintegrating, going into backwardation. You had some accelerated moves to the downside that added fuel to the fire. I think also, just being candid, I think there were probably hedge funds that were playing the gold silver ratio in the high 80s, 90s, early 90s, and maybe going into the upper 90s, being long silver, short gold. And then all of a sudden, when you saw this acceleration of silver dropping to the downside relative to gold, you have to remember these guys don't just simply call up a gold dealer and say, I want to buy ounces of this and ounces of that and buy it in cash. No, they're playing on leverage. So, and they're playing these levered products, and so every little basis point is a huge move in their book. And so when silver started to accelerate to the downside, they probably were forced to unwind that position, and it's probably why you saw some of these jumps in the gold price the last 2 days. You had these spikes coming out of nowhere, and then the silver market just got hammered, and it never really recovered. There probably was some unwind of those gold silver ratio trades that were actually trying to be pro silver, but ended up getting caught in the sell off. So that those are things to watch for. It's not just simply the banking cartel trying to drive the price of metals down. There's a lot of players that are involved in this market, and some of these most simple events or dramatic events that take place can be rolled back to very simple circumstances.
Obviously, the GSR has never spent all that much time above 100 here. I don't expect it to spend too much more time here. So as the GSR eventually corrects back towards its more historical band, do you think that's more gold coming down to meet with silver, or do you think silver maybe has a little bit of a relief rally from here? I know that's kind of a loaded question, but
I think silver is going to find I don't expect this gold silver ratio to stay elevated above 100 for very long. I mean, even in March of 2020, when it went from, was it 80 or so, up to about 125, by the time that thing started to roll over, gold sort of led the charge and held, somewhat firm relative to that massive sell-off we saw in March of 2020. I think when silver does find its low here, and I don't think it has very much more downside to it, I think it's going to catch a lot of people short, and I think you're going to start to see, I think, this next leg. That's why I'm saying when you get into this backwardation, the market's getting very negative. It's going to get short. It's going to get, sentiment's going to get, decimated. People are going to be sick of mining stocks or whatever it may be. You're going to build up a lot of pessimism, and that provides that fuel for the next move to come. And it's the setup. It's that slow moving train that you're trying to, identify the positioning of who's short, who's long, and if we're too short to one side, that'll be the setup, I think, for the next big squeeze. But I think you have to remember, if Trump is successful in this whole sort of managing the market down, then forcing the Fed to start cutting rates and start buying treasuries, for example, you're going to get one hell of a move or a whipsaw to the upside in the general markets that has absolutely nothing to do with the economy. It's going to be where the market got too positioned negatively, and now it's being forced to unwind those hedges or negative trades. That's the scary part, because you could see a very violent move to the upside. You have to remember, in 1929, you saw average rallies of 15% in the marketplace. It was like multiples of those that happened while the market was going down. So it was sucking everybody in, and ultimately, the market dropped 90% from its all-time highs, but it had these magnificent bear market rallies. You could see very similar event take place, and then you have to remember, if the Fed then steps in, that's going to be very positive, I think, for commodities in general, because they're going to be sort of anti-dollar trades. Question is, are foreigners going to continually back out of our country, take their money home? That's the worry that we're trying to, everyone in the financial markets are watching for. Are they going to stay in the U.S. and build factories here and provide jobs? Or these are the questions that are yet to be answered.
Yeah, this is uncharted territory. The world is just, it's so different from the last time tariffs was really a big thing. A lot of people talking about Smoot-Hawley from 1930. This looks nothing like, that's like apples to orangutans comparison. The world of 1930 versus how interconnected everything is today. And in the 1930s, the U.S. actually ran a trade surplus. So now we have the biggest trade deficit in the history of civilization. So it's just really, there is no comparison. There's no precedent. There's no procedure to follow here. Nobody knows. People can make educated guesses, but the history is being written right now. And the point about the volatility in 1929 during the crash, that's a very important thing to keep in mind, because we got 2 consecutive days now of more than 1,000-point losses in the Dow today, negative 2,200 points in the Dow today. So I think like 1,000-point up day is probably in order here. And, sometimes those are the bull traps that suck you back in, especially retail buyers who are prone to those swings. Just be careful out there, folks. When markets are this volatile, and I always tell people, be so careful when you're going out on leverage. Now,
it's interesting, being in the business since 1992, and I've seen a lot of these I call them Thursday, Friday, Monday drops, where you see, you start off on a sell-off on a Thursday, Monday or Friday, you have maybe a bump early in the morning, but that fades, breaks down, closes at the low on a Friday, and you're walking into Sunday night or Monday morning just set up for absolute more margin calls. That typically sets off a potential cascade of more violent downside. We could certainly see that the setup is there. The question is, you always have to look at the politics of do politicians want to stomach the downside? Do they want to try to come out and try to soothe a little bit and take a step back from maybe these hardline positions that they were, maybe trying to use for negotiation tactics, or to try to get the upper hand on another country? This over the weekend, I'm sure there's going to be a lot of one-liners and headlines out there trying to talk back some of the stuff. But if it doesn't, Monday could be, a real difficult day. But I think if you just get it out of the way, I think it sets more tone potentially for this sort of V type bottom, where you could see, like you said, some type of major bounce, whether it's bear market bounce or whether it's, hey, listen, we just flushed everybody out. And now, okay, the Fed says, well, maybe we need to communicate to the markets that maybe easing may be the path. Maybe there's enough destruction there. Powell didn't know what the stock market was doing this morning when he made the comments, or those were pre-written comments, that he wrote maybe 2 days ago before this whole thing sold off. But those are the things you want to watch for, and it's that violent types of moves to one way or the other, and then the reactive move that could come in that could be just as violent, just like you said.
So there's something else I wanted to talk to you about, and it's actually what propelled this interview to begin with. I reached out to you a couple of days ago because last Friday, a week ago, we had this big move in the open interest, and you had posted this. There was Friday, March 28th, we had this big surge, 62,000 contract change in the open interest, and this happened on the last day, right, that the contract was trading, whatever, 0 days to delivery. 45,000 of those contracts was just in April, which represents, like 13 or 14 billion dollars worth of gold at the time. And it really looked like somebody with very deep pockets, probably a bank, was taking delivery of a huge amount of gold. And it didn't get a lot of mainstream media attention, but the gold bugs were flipping out. This is it. They're draining the COMEX. Like all that stuff was flying around in social media. And then I was actually queued up to talk about this on Monday morning on my morning live stream. The whole show was going to be based on it. And then 5 minutes before I go live, the new data comes out, and all of a sudden we've got an 87,800 contract drop in the April contract. And a lot of people were saying this might have been a misprint, or it was a misprint, or someone standing for delivery. And I'm sitting here 5 days later. I still don't know what the hell happened in the open interest on that April contract between Friday and Monday. Can you help us understand what happened there?
Yeah, I wish I was a fly on the wall, I guess you could say, in one of these trading rooms. But I thought what was going to happen was it was a setup possibly to see a lot of metals starting to come off the exchange, or at least come out of the registered category and go back into the eligible category, and probably get ready to ship out to another location. Because you have to remember, the gold market, unlike silver and platinum earlier this week, where the leasing rates were still very high on silver. It was still like 6%. I think at the beginning of this week, platinum was like 15%. There was a lot of stress still there. Gold actually had pretty much normalized. So to me, and gold's EFP had also normalized. So to me, it made sense that gold was probably going to come off the exchange. Yeah, and you have to remember, to store metal in London is a lot cheaper than to put it on receipt at the COMEX and hold it there. There's margin requirements and things like that. Of course, they just got upped, but the cost of storing in London, that's typically why you see so many authorized participants, banks, market makers hold, and the ETFs, for example, they're traded in London because it's just cheaper to store metal over there. That's what I was expecting. And I think, we're still early in April, so I still expect, maybe to start seeing some of these numbers reverse, and, whether it be a roll out of these contracts, especially with the EFP going into backwardation. Now it's more beneficial, or there's profit to be made to actually move that metal back to London, because now the metal is actually more expensive in London than it is actually in New York. And so imagine a wave of metal now leaving, going back across the ocean. Yeah. I guess maybe the airlines will make some money this year.
Yeah, there's no money in carrying people, but the gold that they don't realize is in the belly of that plane. That's making them plenty of money. That's
Sure.
great. So help me then. Was that big open interest spike in Friday and then the subsequent correction Monday, was it a misprint or
I don't
did
think.
somebody
Yeah,
roll it? Yeah, it
it
was
could
mis-
have been. It could have been a setup for either some sort of. Sometimes when you open up a big, obviously for every buyer there's a seller, that type of thing. But it could be a setup where someone that had a short position on the COMEX, and let's say they wanted to take delivery of that metal, well, they'll typically open up a long and net those longs and shorts together, and move that metal out to the long side. And that's what I think was probably happening, is my guess. Yeah, some of these loadouts and some of these movements of the stocks, they don't necessarily correspond that day of when open interest is printed. They got to go through the warrants and the receipts and so forth, and then you see it in the stock reports maybe a few days later. But time will tell on that.
Once again, let me just show this on the screen here. This is Bob's Twitter handle at Profits Plus ID on Twitter. Again, he is the CEO of Idaho Armored Vaults. I'll also put links to Bob's website down below. And Bob, I'll give you the final word. Anything else you want to add?
Sure, just try to remove the volatility day to day, and think about why you bought the metals for the long term. It's very disappointing to see silver go from 34 down to 29 in 2 days. But these are temporary events. The idea of being into the metals is really the longer term nature of owning physical versus the leverage products like futures and options, and even mining stocks for that matter. These types of moves can affect those companies, but the physical metal itself is going to be here around a lot longer than we will. So just try to have a perspective of it's temporary in nature, and that the issues that we're seeing today, we're seeing a complete regime change in terms of potentially history being made, basically, with the over indebtedness of the United States, and the attempt to maybe try to find ways to finance the U.S. government now that that this day was ultimately going to come. It's just been kicked down the road for the last 30 years. And so maybe Trump has basically fast forward this whole event into a very condensed environment to try to get as much change and much drop out of the market as possible, so he has the next 3 or 4 years to affect maybe policy that he thinks will actually maybe better this country. And those are the things you have to kind of focus on. Now, from that standpoint, that would probably mean inflation's going to tick up. My expectation is that the metals are going to probably start to move higher at some point. Because interest rates are going to drop, the Fed's going to come in. These are things that you want to watch for. But right now, it's you got to kind of take all this with a grain of salt.
Wise words as always, Bob. Once again, thank you so much for your time and for sharing your wisdom with us. And everybody else, until next time, live small and dream big.
Thanks, Jack.